Fund Supermart, your online gateway to unit trusts.
Year to date, the European listed sector has returned about 20% as we stand today in late July. Clearly, it's been a beneficiary of the larger than expected quantitative easing announcement by the ECB in early January. So the result has been a repricing of a lot of the continental names in which we invest. We've also seen very strong growth coming through from markets such as the UK, which has been reflected in share prices as we stand today. Looking ahead, we see continued reasons to be positive. Underlying real estate fundamentals have continued to strengthen. We are seeing increased investor demand for real estate, and this has typically been equity-led. So it's pension funds and insurance companies who are increasing exposure to real estate, given that they're starved of income in many of the other parts of the market. So we see this as a very strong backdrop for real estate as an asset class. We have seen more volatility in equity markets in recent months, initially with bond yields moving higher in March and April, and then more recently with the various stages of the Greek saga playing out. Whilst we do pay close attention to what's happening in Greece, it's not something that we expect to directly impact the companies in which we invest. We have no exposure to the Greek market. And our view has been that the financial contagion from what's happening in Greece was likely to be contained. So we watch closely, but we don't expect it to have a significant impact on our markets. And it looks like we may be in for a quieter few months in terms of the macro noise that we've been exposed to over the last month or two. In terms of our positioning, we have continued to have a preference for markets where we see the potential for top-line growth. And perhaps the strongest example of that is the London office market. We're expecting rents in this market to grow by about 10% over the course of 2015. We've recently seen some very strong letting evidence in both the City and West End that suggests that even that number may be exceeded. And even looking into 2016, we've got low vacancy levels, pretty limited new supply coming on stream, and a strong underlying economy that should bode well for further rental growth, not just in the months, but also in the years ahead. So we have had a bias towards the London market within the UK. Elsewhere, we did increase exposure to some of the continental markets at the end of 2014 and in early 2015. There we were really seeking dividend yield, so we felt that dividend yield would become increasingly attractive in a QE world. So stocks like Euro Commercial, which owns shopping centres on the continent, has been an increasing part of our portfolio. We've also sought to target some of the alternative parts of the UK market. So these are parts of the market that we think will benefit from structural growth as well as the positive cyclical upswing that we're in today. So areas here include student accommodation, which we think will benefit from both rising rents and also increasing values as it becomes a more mainstream part of the real estate market. The self-storage sector is also set to benefit from an improving UK economy, and we expect very strong earnings and dividend growth from our two names there, Big Yellow and SafeStore. And finally, we're skewing the portfolio slightly towards developers, which we expect to be able to generate value above and beyond what the wider commercial market does through their development expertise. So as general returns flatten in the years ahead, we think developers will still be able to create outsized returns for us as investors in those companies. So in summary, it's been a good year so far in 2015, but there are still reasons to be optimistic. Underlying property fundamentals remain robust. The companies in which we invest are very well placed to benefit from this strong market. And valuations, whilst not as cheap as they were, we still think are fair given our expectations of the dividend yield on offer and the growth that we expect to see in asset values. So we still expect more to come from listed property in the years ahead.